Welcome back to the Apartment Dealer Show. We're in the middle of our series discussing the three foundational pillars when an investor is building their financial legacy in multifamily investments. For a quick review, pillar one, that's maximization. In maximization, we're talking about increasing your net income, your appreciation or the equity, and taking advantage of more tax savings within the property or properties that you currently own. We're doing this from within of your current holdings. Why? So that we then can pivot to pillar two, which is our topic for discussion today, which is growth. Right? We're talking about in pillar two, the growth of our equity, our net income, further tax savings, and the compound effect that leads to exponential growth. Now, on this show, we talk about growth is a good thing. It's a myth. It's a fallacy that more real estate, more doors, more units has to equate to more headaches. Remember, I'm a realtor and an investor, but I'm a realtor first. And over the last 15 years, I've worked with a couple hundred multifamily investors like you. So I've had the vantage point of working with those that we would call the successful from those that are maybe not as successful. I've had the ability to work with investors who have large portfolios, and yet it doesn't seem to demand much of their time, and also work with other investors who have one property, and that one property runs them ragged. As an investor myself, remember, I run my business, I run my team, I'm a father of 8, right? I have personal responsibilities. So my properties cannot be a big demand on my personal time and take away from these other areas of my life. So in evaluating clients and just my own experience as a landlord, what I've been able to figure out is it basically boils down to one of two things, or maybe even both. One, your management style. Two, your tenant base. When it comes to your management style, obviously we all have different personalities. And what I can tell you here is, yes, we want to be friendly with our tenants, but we also want to keep it business-like. We want our tenants to understand their role as a tenant and who we are as a landlord, and the property belongs to us, and that within the agreements they've signed, there is rules and regulations to follow. Now, to find those individuals that will follow these rules and regulations or to increase the odds, then you want an attractive tenant base. And this goes back to pillar one, which we'll link to that video here. But in pillar one, we discussed, if you had a choice, how do you get the tenant that behaves themselves, that has the money to pay you your monthly rent without having to chase it around on the 1st and the 5th and the 10th? We discussed that. But when people say more real estate equals more headaches, it typically is because the management style is not working. The tenant base is just the wrong tenant base. Now, I know you as a viewer of this show are probably amongst one of three investor types. The first type are those individuals who your investment properties represent the vast majority of your retirement income. So when we talk about growth, any growth today in terms of the growth of your net income will be an immediate increase in your standard of living. Then there's those of you that fit investor type 2, which is you're currently still working, running a business like myself and my wife, and maybe your properties subsidize your current income somewhat. But the real idea, the real goal is that by growing over time, any growth that you experience from today to when the time comes for retirement, when the time comes for your cash flow to take your place, any growth then equals an increase in your standard of living further down the road. And then there's the third type. These are the individuals that I would say you're in your golden years of being a real estate investor. You currently own the properties that you want to own, and maybe you would sell if it wasn't for capital gains tax. And so because of capital gains tax, you continue to hold, or you're thinking about the next generation. You have your kids, your grandkids in mind. And I would put forth this to you. Your children, your grandchildren are going to need more money in their lifetime to create the same standard of living that you've had in yours. Take, for instance, home ownership. It's very likely that your children are going to own a home or owned a home later in life compared to when you bought your first home And we can only assume with the cloud of student debt and other factors, your grandchildren will have the same struggles. So for your heirs, any growth that you take advantage of today means an increase of standard of living for them down the road. So we're one of three investor types. Either case, growth is good. Now, to not grow looks something like this. You own that one or two properties, and you're trying to extricate all your financial goals and dreams from that single property because you refuse or you avoid change. You think there's no other building like your building, there's no other tenants like your building. And so because of that philosophy, you might fall under the realm of shrinking your financial goals and dreams to meet your net income, as opposed to expanding your net income growth, pillar 2, expanding your net income so that it'll meet, better yet, exceed your financial goals and dreams. And that's really what pillar 2 is all about. Now, I'm going to take you to some footage of the most recent live educational event that we held for landlords like you, where we see where can we apply pillar 2 and actually go through some investor stories. Let's go to that footage now. Now they can pivot and move to pillar 2, which is growth, through a 1031 exchange. Now, the client that I'll discuss here is the Sanchez family, because it fits many attendees who have come in the past. The Sanchez family, when I met them, had owned their building for about 25 years, free and clear. And when I come into the world, this is where they are. Chris, you don't understand. There's no building like our building. And there's no tenants like our tenants. Even if they're on the welfare plan for rent. Any of you do this plan? You take some on the 1st, some on the 5th, some on the 16th. Some of you do this? Okay. Even though some of them were on that plan, there was no other tenants like their building. And after all, Chris, if we sell and exchange, the property taxes are going to go up. We're going to go from no mortgage to a mortgage. There's no way, no how that you could help us earn more net income. Now, I have the liberty of looking from the outside in, and I realized that, but I said, let's just look at the math. Let's take everything else off the table. My opinion, your opinion, but what does the math say? So we did an evaluation. They had $900,000 in equity. So I need to back up. They actually did have a loan. That was a mistake. They did have a loan. So they had $900,000. So if they sold the property at its current value, after closing costs and paying off the first, they would carry over $900,000. I found for them this 17-unit building in Baldwin Park. If you take a look at the gross income on the 10 units, it's $108,000. On the 17 unit, it was $208,000. How does it play out after a mortgage and increase in taxes? Well, these are real numbers. Their net income when they owned the 10 unit was $34,800. After completing the exchange, it jumped to $45,740. That's a 70% increase in the number of units owned, 10 to 17, and it's a 31% increase in net income, net spendable income. Maybe to make that more applicable for you, for every $100 that you currently collect in rental income, what if you could collect 130? And I would put forth the argument that in a state of rent control where maybe you got caught flat-footed and your rents are quite low, an exchange is one of the best ways for you now to start exponentially growing, because tell me this, if they would have held, at what point could they have collected 17 rents on 10 units? I'll give you a minute, you have calculators. At what point? 17 rents on 10 units. It can't be done. Now, for the skeptics that are saying, well, Chris, you're trotting this one out because that's that one unicorn deal. Better yet, it's a leprechaun riding a unicorn, but you can't find me another one of those. Well, let's take a look. Another client in the room, 3 units, East Los Angeles. Net income was $18,000. Now, they had done the capital improvements that I suggested, completely rehabbed to the studs. New insulation, drywall, plumbing, electrical, beautiful. One might say, well, why sell it, right? You've done the improvements, you're obtaining market rent, why? On top of that, they had significant sentimental attachment to the property. Their grandfather owned the property, then their father and uncles, eventually them. I mean, their godmother, her handprint was in the concrete from when she was a little girl with her name signed. It doesn't get much more sentimental than that. But looking at the math, when all was said and done, by doing the exchange into this 8-unit in Maywood, the renovation needed was $100,000. The net income was $52,400. The rate of return on their money was 8.6%. That's almost a 200% increase in cash flow and 160% increase in the number of units owned. Now, that client is myself and my wife. So I'm trying to put forth the idea here that me included, with my godmother's handprint and all, had to step back and at least take a look at the math. Because if I'm being honest with myself and I'm saying, hey, these properties are going to provide for me sometime down the road. I like my standard of living now. I don't want it to change in the future, so I need to replace that in passive income. Instead of always adding new cash to the deal, because some of you maybe don't have that opportunity. I realize maybe there's some doctors and lawyers in the room, and every year you have a big injection of cash you can just buy. But for a lot of us, we're equity rich. It's the equity that we need to put to work in order to change our financial trajectory. So we have to analyze to see if it's ideal. Now, so that we know that this is real. She didn't know I was going to do this, but I'm coming. And she's hiding. So I'd like to introduce you to Rita. I know this is hard, so let's just pretend it's me and you talking. Okay. Now, Rita was just here in March. Prior to March, we had never met, right? We had never met prior to March. You catch the vision of an exchange for you and your family. And I'll hand you the mic. Let's take it from there. How long had you owned your building in Downey when we met?
More than 34 years.
You have to hold it up.
More than 35 years.
Wow. And
a lot of equities there.
Why, in those 35 years, why hadn't you done an exchange earlier?
Oh.
Honestly.
Okay. We thought the income we have is very comfortable. We didn't think about the leverage of the equity in there.
So you come to the luncheon.
Yes.
I remember you and your son Chuck introduced yourself as you were leaving. And many people do. They get excited. They're at an event. Chris, call me. And I never hear from them. I don't get their little card, right? So, but this was different. You invited me to your home. We analyzed it.
Yes.
You owned it for 35 years. You know the tenants inside and out. You know the building inside and out. You're comfortable in terms of your financial means. So why do the exchange?
After your explanation to me to use the equity, we can buy a bigger apartment. So I have bought from 10 units, changed to 14 units. That is about how many? 40%?
40% increase.
Income, yes.
Sure.
And I'm very happy.
And you just closed escrow on the new building when?
On the September 25th, a few days ago.
Excellent. Everyone, let's give Rita a round of applause, please. So there you have two separate investor stories. You have Rita, which fit more of the investor 3 type, where she was in her later years. Her property was free and clear. She really wasn't in need of any more income herself, so to speak, but for her children. By doing the exchange, it meant a 40% increase in the number of units now that's in the family legacy. And it also equated to an increase of the net income, not only for her to enjoy currently, but more importantly, for her son to enjoy, and a way for them to hurdle over the current restrictions of rent control and to grow at an accelerated rate. With the Sanchez family, you heard impressively, they increased their holdings, the number of units, by 70%. They increased their net income by 30%. Now, the Sanchez's fit more of the scenario of investor 2, where they're both still working. Mrs. Sanchez is employed. Mr. Sanchez ran his own business. So their investment properties supplement their income somewhat. And currently, truthfully, they're making money hand over fist. And every year, let's say they choose to hold this 17-unit building, as they continue to raise rents, not only did they leapfrog well over the rent control limitations, but it's that much more money down the road. Let's take a look at this from another vantage point. When we start talking about the exponential growth, because I get asked, well, Chris, okay, we understand the 1031 exchange process. And of course, you 5 units to 10 units, you'll see some growth there in the income. But what are you referencing when you say exponential growth? Well, let's take a look at it this way. Let's say, for example, you had 2 separate apartment buildings. You had a 6-unit building and a 10-unit building. And you decide on both buildings to issue $50 rental increases. So for the 6-unit, if you give each tenant a $50 rent increase, that equates to $300 per month, which equates to $3,600 a year. And then if we take a look at the valuation of that property, remember, going back to some of our earlier videos, which we'll link to here, specifically our video on GRM, gross rent multiplier. Gross rent multiplier is one of the 4 factors we use as brokers when we're evaluating the value of an apartment building. So on this 6-unit building, we increased the annual income by $3,600. So if we use GRM and we use 13 GRM, that would give us an increase in the building's evaluation by $46,800. Chris, how did you get there? Well, you had $3,600 more in rental income a year from the $50 rent increase that you gave each unit, and you multiply that by 13 GRM, that gives us $46,800. Now, let's do the same thing to the 10-unit building. We give all 10 tenants a $50 rent increase. That equates to $500 a month. Yearly, that is an increase in gross income of $6,000. Let's use the same valuation factor of 13 GRM. That increases the valuation of that building by $78,000. $6,000 times 13 is $78,000. So ask yourself this. Let's take the buildings out of the equation. Let's just look at it as 2 banks. Bank A, you have $1 million to invest, right? You probably have $1 million in equity, let's say, in your building. You have $1 million to invest. Bank A is offering 4.7% return. Bank B is offering 7.8% return. Which bank are you going to? We're all going to Bank B. So when we look at it this way, we understand, okay, I can see how even just simply raising income increases my appreciation. Well, let's talk about a net income then. Keep in mind, every year you give an annual rent increase, especially in light of rent control. Because many of you own in locations because of rent control where you can only raise rents maybe 3% a year, 5% a year, 7% a year. But let's say it's 5%, okay? And let's say we found by doing an exchange analysis that by selling your current building and moving on to something slightly larger with more income, you would actually increase your net income. Okay, your net income, the money that you can go down to Vons and buy your groceries with, right? Because that's what counts. Cash flow is key. Your net income, let's say it would increase by 15, 20%. You can choose to hold and be limited by the government and handcuffed 5% a year, once a year, or you can do an immediate leapfrog over the 5% in an exchange, say by 3 or 4 times, depending on if you increase that net income by 15 or 20%. With the Sanchez family, you saw that we increased it by 30%. That's how you beat rent control, and that's how you increase your net income. And then let's talk about tax savings. Remember, many of you have held a property for any length of time. What's dwindling in the background? Your depreciation. Well, if you go through the exchange process, now you have some of that depreciation back. So you're making more money and you have more tax savings to put against that increased revenue, which means what? It's more money in your pockets. So let me ask you this. What is it that you like spending your tenants' money on? Because that's what cash flow amounts to, right? Your tenants have your cash flow in their pockets. We're in this second pillar of growth. We're saying, hey, let's not only increase it by 5% because the government tells us that's okay to do so. Let's increase it by 15 or 20. Let's expand our portfolio. Let's take advantage of all the good things that real estate has to offer. For myself, as I mentioned, I'm a father of 8. Our properties somewhat supplement our income. Our kids go to private schools, right? All of us have different things that the cash flow from our properties take care of for us. The cash flow means different things to all of us. We all have our own investor story. But at the end of the day, math is math. So what I'm asking here is, it takes one to do a financial analysis, not an emotional analysis, right? Because I understand that many of you, we talk about an exchange, it elicits some fear, going from the known to the unknown. And we walk our clients through this every day. We help multiple clients on an annual basis go through 1031 exchanges, and everyone starts out about the same place. Chris, even if things aren't ideal, what if it's worth in the next property? Chris, what if I sell my place and I can't find a good replacement property? What if at the end of the day, by an increase in property taxes, an increase, maybe I have no debt, now I'm going to have debt on a new property. Will that really equate to more net income? Here's what I'll say to those 3 questions. First of all, with respect to the tenants, it's easy for people to assume, right? We all assume that maybe we're doing a better job than everyone else, that we think the next guy's a slumlord compared to maybe how we manage our properties. It's not the case that any other potential deal, those tenants are somehow misbehaving to a worse degree. Now, when it comes to the question of, can I find a replacement property? We did an interview with Greg Burns, and we'll link to that video here as well. I asked Greg that specific question. Now, Greg Burns is with IPX. They're the nation's largest accommodator company. When you sell an investment property and do a 1031 exchange, when you're between your property and the next property, your money is held by an accommodator. And I'll refer you to that video for the explanation. But here's the point. They're the nation's largest, meaning they deal with more people in 1031 exchanges than anyone else. And I asked Greg, is it the case where you see people selling property, getting stuck, not being able to find a replacement, or they sell something and then they just buy whatever because they want to avoid the capital gains tax? He said that's not the case. There's a small margin of people that maybe given their own, they drug their own feet or something, that get stuck, but it's not the case. And I can tell you from my own experience, we help multiple investors on an annual basis go through the 1031 exchange process. Not one have they ever got stuck not being able to find a replacement property, let alone not find something that met the goals that we had established before we even began the whole exercise. My wife and myself, we've been through our own 1031 exchange. We came out the other side just fine. What it takes to know the opportunity is a financial analysis, not an emotional analysis, right? I understand the hesitancy, but the hesitancy is there, I would argue, in many cases, because we haven't taken a look at the math. Meaning, what am I currently netting from my property or properties now? Truthfully, at the end of the day, net income, money that you can go down to Vons and buy your groceries with, versus if I were to do a 1031 exchange, what would the net income, even after the increase in property taxes, the new mortgage and everything else, what would that net income look like? And then we compare side by side to see what is the opportunity. That's how, in fact, you can make a rational decision based upon the math. So growth, pillar 2, growth is good. Keep in mind, as landlords, we have 3 things invested already. We have our time, we have our capital, and we have our head on the line in terms of the risk involved of being a landlord. Our time, your time and energy is already invested in the management of your properties. Your capital or your equity that's in your current property or properties is already invested. The risk, if you followed any of the interviews that I've done, say with the real estate attorneys, you know that the risk here in California only grows by the day with all the new rules and regulations. So since we already have that investment made, why not ask for, demand, if you will, a greater return for that investment if the opportunity is there? That's what Pillar 2 is all about. Growing from where we currently are, making that leapfrog over what the government is saying they'll restrict us to, and then exponentially growing from there. I hope these videos help. The premise here is that we're sharing that information that will assist you as a landlord in the building of your financial legacy. That's what we're building here. In buying and investing in multifamily properties, you and I are building a financial legacy for ourselves currently and for our heirs to come down the road. Chris German from The Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.